If you have stock options as a part of your compensation, there's really two things you need to understand. First, you've got to understand what type of options you have. And second, you need to know how alternative minimum tax works. Most clients I talk to normally know if they have stock options, and they generally know roughly what they're worth. But if I ask them if they have incentive stock options or non-qualified stock options, I usually get a little bit of a blank look. And if I ask them if they have thought about the alternative minimum tax, it's the same thing, the blank stare. So that's what we're going to cover today. I'm Bjorn Amundsen, a certified financial planner with Quarry Hill Advisors. We're a financial planning firm here in Minnesota, and stock option planning is something that we deal with regularly. So first off, you should know there's two types of stock options: incentive stock options, which we call ISOs, and non-qualified stock options, which we call NSOs. The tax treatment is completely different, and so you need to know which one you have. So let's talk about ISOs, the incentive stock options, first. So ISOs can only be granted to employees, not to contractors or advisors or board members. Employees only. And the main benefit of an ISO is that you don't have to pay ordinary income tax on it when you exercise them. You get to buy the shares at the strike price, and there's no immediate tax hit on the difference between what you paid and what the shares are worth. But of course, there is a catch. The ISOs are subject to the alternative minimum tax. So I'll explain what that is in a minute. So to get this favorable tax treatment on ISOs, you have to hold the shares for at least 1 year after you exercise, and at least 2 years after the grant date. If you meet both of those requirements, then when you eventually sell, you only have to pay long-term capital gains rates instead of ordinary income. That can be a meaningful difference. We're talking about a top rate of maybe 20% for capital gains versus 37% for ordinary income at the federal level. Sometimes that capital gain rate, if your income is low enough, will only be 15%. It just depends a little bit on what your situation is. So a few other things about ISOs. There's a $100,000 limit on the value of the ISOs that can vest in any given year. And they expire 10 years after they are granted. And if you leave your company, you only have 90 days to exercise them and be able to keep the ISO tax treatment. So that's a little bit of the basics about ISOs. Let's talk about the non-qualified stock options, NSOs. NSOs are more flexible. They can be granted to anyone: employees, contractors, advisors, board members, and the tax treatment is straightforward but less favorable. When you exercise the non-qualified stock options, you're going to pay ordinary income on the spread. The spread is the difference between what you paid, maybe $5, your strike price, and the fair market value of the shares on the day you exercise. Hopefully that's $10, $20, or $30. That spread is treated as compensation. It's going to show up on your W-2, and you're going to pay income taxes on it. And so you're also going to even have to pay payroll taxes on it, which means you're going to have Social Security and Medicare taxes on it. There's no special holding period on the non-qualified stock options, and the tax hit happens at exercise, period. So for most people, we're going to exercise those and sell the shares immediately, as opposed to holding like you might do with an ISO. So here's a simple version. With ISOs, you don't pay the tax at exercise, except potentially you might have to pay the alternative minimum tax. And if you hold long enough, you're going to pay capital gains when you sell. With the non-qualified stock options, you're going to pay the ordinary income tax at the exercise and then pay capital gains on any appreciation that happens after you sell. ISOs sound better, and in many cases they are, but the AMT piece complicates things. Let's talk about the alternative minimum tax complications. The alternative minimum tax is a parallel tax system. It was created in 1969 to make sure high-income taxpayers couldn't just use deductions and exclusions to avoid paying taxes entirely. So here's how it works. You calculate your taxes twice. Once under the regular system, and then once under the AMT system. And then you have to pay whichever number is higher. The AMT system adds back certain items that you can exclude or deduct under the regular system. One of those items is the spread on your ISO exercises. So when you exercise the ISOs and hold the shares, you're not going to owe any regular income tax on that spread. But you do have to add that spread on your income when calculating the AMT. And if your AMT calculation comes out higher than your regular tax, you have to pay the AMT. Now, of course, this might be a surprise for some people because they exercised a bunch of ISOs. They didn't sell any shares, so they got no cash out of the deal. And then you get a tax bill anyways. So they have to have some cash on the side that they can pay that tax liability with. So let's go through the actual figures because this matters in financial planning. For the tax year 2026, which you'll file in early 2027, the AMT exemption is $90,100 for single filers and $140,200 for married filing jointly. The exemption is the amount that you can earn before the AMT starts to apply, so not very high at this point. The exemption is going to phase out once your income hits a certain level. So for 2026, the phase out starts at $500,000 for single filers and $1 million for those who are married filing jointly. And the phase out rate is 50 cents for every dollar over the threshold. This is actually a pretty significant change in 2025. The One Big Beautiful Bill Act, which passed July 2025, lowered those phase out thresholds and doubled the phase out rate. So in 2025, the thresholds were $626,350 and $1,252,700. So more high income taxpayers are going to be affected by AMT starting in 2026. So if you're a high earner with large ISO exercises, you need to model this out pretty carefully before you do anything. Now, there is some good news. When you pay AMT because of the ISO exercises, you can generate what's called an AMT credit, and that credit carries forward indefinitely. In future years, when your regular tax exceeds the AMT, you could use those credits to reduce what you owe. So the AMT issue on ISOs is more of a timing issue than a permanent extra tax. You're essentially prepaying taxes that you would have owed later, but it still does create a cash flow problem in the year you exercise, and you need to be ready for that. Let's talk about when to exercise your options. There's no single right answer on when you exercise your options. It depends on your situation, but here's the factors that I like to think about with clients. First is the spread. The spread is the difference between your strike price and the current fair market value. It's what you can get if you exercise right now. A larger spread is going to mean that there's going to be a bigger tax impact, whether it's AMT for ISOs or ordinary income for non-qualified stock options. So if the spread is small, you're going to trigger minimal tax, and you can start your holding period clock for long-term capital gains treatment. If the spread is large, you're going to need to think carefully about the tax bill you're creating. The second thing to think about is how long you have until you exercise. This is almost like a lottery ticket value for your shares. So imagine you can buy some shares for $20 and they're currently trading at $50. Pretty good deal. And if those options are going to expire tomorrow, you should probably go ahead and do it so that you can cash in on this before they expire. But if it doesn't expire for another 10 years or so, you might want to hold off and think about it. There's an important balance to get between the in-the-money value or the spread value and the how long until it expires, which is kind of like your lottery ticket value. And when your spread or your in-the-money value is really large and your time value of how long till it expires is small, you should probably think about exercising regardless of the tax consequences. We can help you calculate this and figure out the optimal timing for your options if you want help doing that. It involves some complicated math, and you're going to need some formulas and data that you may not have available to you. The other thing to consider is your taxes, your income this year versus other years. Tax rates are progressive. If you're having a lower income year for whatever reason, that might be a good time to exercise your non-qualified stock options. You'll pay a lower marginal rate on those. For ISOs, a lower income year means you're less likely to trigger AMT, and so you'll trigger less of it. On the flip side, if you're having a high income year this year, maybe because you got a bonus or some restricted stock units, adding an ISO exercise on top of that could push you really far into the AMT territory. The other thing to think about is when in the year to do it. Early in the calendar year can be an advantage for some people. I generally recommend exercising early in the year if you have ISOs. And here's why. If you exercise your ISOs in January and hold the shares, you've got the rest of the year to see what happens. If the stock drops significantly, you can sell before the year end and avoid the AMT adjustment entirely. That's called the disqualifying disposition. You lose the favorable capital gains treatment, but you can also eliminate your AMT problem. If you exercise in December and hold through year end, you're pretty much locked in. The AMT adjustment is going to happen regardless of what the stock does after that. Now, if you have a large option grant, you don't have to exercise it all at once. You can exercise it in chunks over multiple years, which spreads out the tax impact. This is particularly useful for ISOs. You might exercise enough through each year to stay below the AMT threshold, or at least minimize how much AMT you're triggering. All right, so let's walk through some specific strategies. For ISOs, meet the holding period. If you can afford to hold, the math usually is going to favor it. You need to hold for at least 1 year after you exercise and 2 years after the grant date. And then you get the long-term capital gains rate on the entire gain from your strike price. Yes, you might pay some AMT along the way, but remember that generates credits that you can use later. And capital gains rates are meaningfully lower than ordinary income. For ISOs, calculate before you exercise. Don't exercise your ISO without running the number first or having us help you with that. You need to know what your AMT exposure is going to be, and you need to know if you have the cash to pay that bill. And you need to understand what's going to happen if the stock drops after you exercise. So we build projections like this for clients before they exercise anything. It isn't something that you're going to want to figure out after the fact. For non-qualified stock options, low income years can be a really good year to do it. As a reminder, they are taxed at ordinary income. And if you have the flexibility on the timing, exercise in the years when your income is lower. You'll pay that lower marginal rate. For non-qualified options, you should also try to spread it out. It's the same concept as ISOs. If you have a large non-qualified stock grant, don't exercise it all in 1 year and spike yourself into the highest tax bracket. Spread it over multiple years. Charitable giving. If you are charitably inclined, donating some appreciated shares can be really powerful. You get a deduction for the fair market value of the shares, and you can avoid paying capital gains on that appreciation. This works really well for shares that you've exercised and held, but it's not going to work for unexercised options. But if you're exercising and sitting on a bunch of gains, you could contribute those shares to a donor advised fund or another charity you know, and it can be way more tax efficient than selling and then donating the cash. Leaving the company. This is where people can get into trouble. You leave the company, maybe it's voluntary, maybe it's not, and suddenly you only have 90 days to make a decision about your stock options. For ISOs, that 90-day window is firm. And if you don't exercise within the 90 days of your last day of employment, your ISOs either are going to expire or convert to non-qualified stock options, depending on your company's plans. Either way, you're going to lose the ISO tax treatment. For non-qualified stock options, some companies offer longer exercise windows, but 90 days is still pretty common. So you're in this tough situation where you have a limited amount of time to figure out if you want to write a large check to buy shares in a company that you don't even work for anymore. Here are the questions I ask. First is, what is the value of your shares in the money value versus the time value before they expire? Again, if that ratio is low, meaning you don't have a lot of time or they've gone up a lot, it's probably a good idea to look pretty hard at exercising. The second thing I'm going to look at is, what is the tax bill going to be? For ISOs, we need to be careful about that AMT exposure and make sure we have the cash to pay it. For non-qualified stock options, we should make sure that any taxes withheld is enough to cover the tax bill that's owed so that you don't have any surprises come the end of the year when it's tax time. We also want to look at what you believe about your company's future. Is there a realistic path to a liquidity event like an IPO or an acquisition? And what's your honest assessment of the company's prospects? How long until that liquidity event? And if it's years away, you could be tying up capital in an illiquid investment for a long time. The next thing to think about is what percentage of your net worth does this represent? If exercising would put 30 or 40 or 50% of your net worth into a single private company stock, that could be a lot of concentration risk. Can you afford to lose the entire investment? Both public and private company stocks can go to zero. And even if they don't go to zero, it's real easy for your stock options to go underwater and become worthless. If losing this money is going to meaningfully impact your financial security, that's probably the most important information you need to know. So there's no universal right answer. What's not reasonable is making a rushed decision in that final week of your 90-day window because you didn't think about it until then. So if you're leaving a company with stock options, you need to start thinking about this immediately. So let's summarize what we've covered. First, you know what type of options there are. You have your ISOs and your non-qualified stock options, and they have fundamentally different tax treatments. You can't make good decisions without knowing which one you have. Second, understand AMT before you exercise your ISOs. The spread on the ISO exercise is an AMT preference item. So if you exercise and hold, you could owe taxes even though you don't have cash. The 2026 rules make this even more likely for high-income taxpayers than it was in prior years. Third, be thoughtful about timing. Early in the year gives you that flexibility, and spreading exercises across years reduces the tax spike. Lower income years are better for non-qualified stock options. Fourth, if you're leaving a company, don't wait until the last minute. You have 90 days, and use that time to actually think through the decision and not panic. And last of all, make sure you're working with a professional who understands this. Stock option exercise timing and taxation is complicated, and the interplay between your regular tax, your AMT, and state taxes and your overall financial plan is not something you should just guess at. So that's what we do at Quarry Hill Advisors. And if you have questions about your specific situation, make sure you reach out and schedule a time with me or one of our other planners. Thank you for watching.